ladies and gents, introducing you to the spinners, and they tripping. Ladies and gentlemen, this song is called Pipe Dream, and Pipe Dream was on the other side of the single called Cupid. And if you guys remember Cupid, this was on the opposite side. And all I can say is this is the Spinners, everybody. And this is one of those songs that I listened to as a child because I wasn't afraid to turn over the single and listen to the song on the other side. Okay? Got something I need to show y'all. Now, that's why we're talking about this, because I have to show y'all something that I promise you, you're going to appreciate this. Any of y'all got a mortgage? Well, what I put in here shall be receivable at par in all parts of the United States. The said Federal Reserve notes shall be obligations of the United States. Now, see, it said the Federal Reserve note, so I got upset because that's not what I asked it for. So I said, hey, Case Text, I'm going to ask you over here. Now, I want y'all to see what we put in here this time. This is talking about pending local Federal Reserve note, the collateral security and all that. Put that junk in here, and this is what we got. The Valley payable could not be offset or netted against the Valley receivable since, as stated, Continental's obligation to Valley were in the form of negotiable notes, and Valley had endorsed in blank to the two banks and used as collateral to obtain cash from which it lent to Continental. Ladies and gentlemen, the practice is that they take your notes, they receive the cash, and then they lend the cash to other banks. But no, hold on. You need to understand. They receive the cash. Okay, but then they lend the cash to other banks. That's not your problem because the cash offsets the credit that they extended to you to pay the owner of the property that you purchased, whether it be a car or whether it be a home. Okay? You have the right to offset under the common law. Now notice this, holding that the UCC does not apply to a pledge or transfer of a bank account, and therefore the validity of such an arrangement is tested not under UCC but under the common law. Okay, not the court's common law. Woo-wee! Now the standard for negotiating a loan from a bank on April 4th, 1964, this is a case that I stumbled upon. This is what led to all of this because I was looking for something specific, and this is the case that came up. Acquired the Williams note. So this bank acquired the note from Williams and its security at par for its total value and deposited the note and the security, deposited the note and the security with the lending bank as collateral security for the loan. Ladies and gentlemen, this is done all the time. The note being collateral security. Master pledge and security agreement incorporated into the credit agreement required the borrower to pledge back the loan proceeds to the lender as collateral for the loan. That's not the one we're looking for. The loan was secured by similar collateral, and the collateral which the lender's bank accepted as security for the original loan. Ladies and gentlemen, when the local Federal Reserve agent receives that and they do not reject it, it's deemed accepted, and they accept it as collateral security. So all of you who've gotten a copy of your notes from the lender, they put it on the record. That's proof they accepted it as collateral and security for the loan. How do we know that that's proof? Because they're local Federal Reserve agents operating under the Federal Reserve Act, and that's Section 16 of the Federal Reserve Act, paragraph 2. That's how we know. So, not going to be a long video, just wanted to point that out to you guys. Now look, It's a lot that I put in here. Okay, so I'm gonna take this right here and I'm gonna put this link, case text link, I'm gonna put it in the description, and that way you guys can go read it for yourself. You can read all the cases where collateral security is pledged, people. The bank accepted the note as collateral and made the Blevins loan. They accepted the note as collateral and made the Blevins loan. They accepted the note as collateral. Ain't that interesting? Okay. Agree to the loan, the money in exchange for additional collateral. Now that's additional collateral, but they didn't ask you for additional collateral, did they? And gave the bank collateral for the loan. Collateral for the loan is the note when you're dealing with Federal Reserve agents, local Federal Reserve agent who accepted the notes as collateral security. Not my problem. The notes were subsequently pledged as security for the loan obtained by Northwest Mutual Savings Association. They trade loans all the time. So Freedom of Information Act those mother and ask them to document the process whereby they use notes as collateral for loans between other banks. You see, ladies and gentlemen, you guys are not understanding the process. When you do your note, the banks are trading these notes between each other and they're getting paid. Well, if they're being paid off of your note, you should be compensated, don't you think? Your account should be offset because they're using your promissory note to get paid. A promissory note, they're just the holders of, they're not the owners of the note. Say what? They're the holder of the note, they're not the owner. You're still the owner, just like you're the owner of the automobile until you pay it off. Well, you're still the owner of the note until it's paid off. The note is only security. Okay, so ladies and gentlemen, I'll put the link under here for y'all. With that being said, gotta go, gotta go, gotta go, gotta go. Have a good day, y'all.